pattern became visible when I stopped looking at charts and started studying history. Not market history, actual history. The kind with presidents and oil embargoes and monetary experiments that changed how money worked for generations. What I found explained why certain investors became extraordinarily wealthy during periods that devastated everyone else. The wealth transfer wasn't random. It followed logic rooted in how central banks respond to crises. The same logic that operated 50 years ago is operating again right now. Most people will miss this opportunity entirely. They're focused on the wrong indicators. They're listening to experts who understand normal market conditions, but haven't studied what happens when conditions become abnormal. They're positioned for a world that no longer exists while the new world creates fortunes for those who recognize it. Today I'm connecting dots that mainstream financial commentary refuses to connect. The parallels between current conditions and a specific historical period that created enormous wealth for positioned investors. What the Federal Reserve is likely to do and why. Which assets historically benefited during similar periods, and how understanding these patterns could make the difference between watching wealth evaporate and watching it multiply. I'm not predicting the future. Nobody can do that reliably. I'm showing you how the forces currently in motion have operated before and what happened when they did. The decisions you make with this information are yours alone. But ignoring this information because it challenges comfortable assumptions would be a mistake. What's happening right now deserves serious attention from anyone who cares about their financial future. Let me show you what I see. The similarities between current conditions and the 1970s are too significant to dismiss. In the early 70s, the United States faced a monetary transition with profound implications. The country had abandoned the gold standard, severing the dollar's connection to physical backing. This freed the government to expand money supply without previous constraints. The expansion produced inflation. Not immediately obvious inflation, but building pressure that eventually erupted into price increases that shocked consumers and destabilized the economy. Simultaneously, geopolitical conflict in the Middle East disrupted oil supplies. The oil embargo created shortages and price spikes that rippled through every sector of the economy. Energy costs affected transportation, manufacturing, food production, and heating. Nothing escaped the impact. The combination of monetary expansion and energy shock created conditions that conventional economic theory struggled to address. Inflation and economic weakness arrived together, confounding policymakers who assumed they faced one or the other, not both. Look at today through this lens. The pandemic triggered monetary expansion that dwarfed previous episodes. Trillions of dollars were created and deployed in months. The money supply expanded at rates never seen in peacetime. The constraints that previously limited creation were abandoned as emergency justified whatever response authorities deemed necessary. This expansion produced inflation that initially surprised observers and eventually became impossible to ignore. Price increases across all categories, consumer distress as purchasing power eroded, the same dynamics that followed monetary expansion in the 70s, following the same cause today. Geopolitical tensions affecting oil-producing regions have driven energy price volatility. Conflicts, sanctions, and production decisions from major producers affect global oil prices. The dynamics differ in specifics but rhyme in consequence. Energy costs propagate through economies affecting everything. The patterns align, not perfectly. History never repeats exactly, but the rhyming is unmistakable once you look for it. Understanding how the Federal Reserve responded to similar conditions reveals what might happen now. In the 70s, the Fed initially responded inadequately. They underestimated the inflation problem. They prioritized avoiding recession. They delayed aggressive action, hoping conditions would normalize on their own. Conditions didn't normalize. Inflation accelerated. Eventually, under Paul Volcker's leadership, the Fed implemented severe interest rate increases. Rates reached levels that seem almost unbelievable today. 20%. The economy entered painful recession. Unemployment spiked, asset prices collapsed, but the aggressive action ultimately broke inflation's hold. The economy recovered. The foundation for subsequent decades of growth was established through short-term pain that created long-term gain. The Fed today faces similar choices. Raise rates aggressively to fight inflation at the cost of economic pain. Lower rates to stimulate activity at the risk of worsening inflation. Or try to thread a needle between these extremes that may not actually exist. Different factors complicate today's decisions in ways the 70s didn't present. Political influence on Federal Reserve leadership has increased. Independence that previous Fed chairs exercised may be constrained by administration priorities. The selection of new leadership reflects political preferences about monetary direction. The pressure for lower rates comes from multiple directions. Housing affordability depends on mortgage rates. Government debt service costs rise with rates. Asset prices that support consumer confidence depend on accommodative policy. These pressures may produce different Fed behavior than the 70s eventually saw, rather than aggressive rate increases that break inflation at economic cost. Current leadership might prioritize different objectives. A weaker dollar, more accommodative rates than inflation would traditionally justify, acceptance of higher persistent inflation as preferable to recession. Understanding this possibility shapes investment strategy. If the Fed prioritizes different goals than inflation control, assets that benefit from that policy orientation become attractive. The mechanics of how interest rates affect wealth deserve clear explanation. When the Federal Reserve raises interest rates, borrowing becomes more expensive across the economy. Mortgages cost more, business loans cost more, credit card rates rise, consumer debt becomes harder to service. This increased cost slows spending. People buy less because borrowing is expensive. Businesses invest less because financing costs undermine returns. Economic activity decelerates as higher rates ripple through decisions. Asset prices typically suffer during rate increases. Stocks become less attractive compared to newly available high-yield bonds. Real estate values decline as higher mortgage rates reduce what buyers can afford. The wealth effect reverses as portfolio values fall. When the Federal Reserve lowers rates, opposite dynamics operate. Borrowing becomes cheaper, spending accelerates. Asset prices typically rise as investors seek returns in a lower yield environment. Understanding Fed actions helps investors anticipate market shifts. If you expect rate increases, positioning for assets that perform well during tightening makes sense. If you expect rate cuts, assets that benefit from stimulus become attractive. The current situation involves uncertainty about Fed direction. Inflation suggests rates should remain high or increase. Economic weakness and political pressure suggest rates should decrease. The resolution of this tension determines which assets perform well. Investors who understand these dynamics can position for various scenarios, rather than being surprised by whatever unfolds. Geopolitical events affect investment opportunities through their economic consequences. Middle East conflicts have historically driven oil prices higher. When conflict threatens production or transportation of oil, supply concerns push prices up. Higher oil prices create inflation that spreads throughout the economy. Current tensions follow this pattern. Conflict in the region, uncertainty about supply, oil price volatility that affects transportation, manufacturing, and consumer costs. But geopolitical factors extend beyond oil. Tariff policies affect prices directly through increased costs on imported goods. Unlike the 70s when tariffs played less role, current trade policy uses tariffs as strategic tools. These tariffs increase prices for consumers on affected goods, contributing to inflationary pressure. Global central bank behavior creates additional dynamics. Many central banks worldwide have been accumulating gold reserves. This purchasing by institutions that understand monetary dynamics sends signals about how sophisticated observers view currency risk. Artificial intelligence development creates investment themes that didn't exist in previous eras. The technology investment driving certain sectors today has no parallel in the 70s. This difference means blindly following 70s patterns would miss opportunities unique to current conditions. The interplay of these factors creates complexity that simple historical analogy can't fully capture. But understanding each factor's potential influence improves decision-making even without perfect prediction. Certain assets have historically benefited when conditions similar to today's prevailed. Gold performed exceptionally during the 70s inflation, from roughly $35 per ounce at the decade's start to over $800 by its peak. The metal that central banks now accumulate appreciated enormously as currency purchasing power eroded. The logic is straightforward. Gold cannot be printed. Its supply increases slowly through mining regardless of monetary policy decisions. When currencies lose value through expansion, gold maintains purchasing power by comparison. It serves as insurance against currency debasement. Current conditions include factors that historically favored gold: money supply expansion, inflation concerns, geopolitical uncertainty, central bank accumulation. The factors that drove 70s gold performance are present today, suggesting potential for similar behaviour. Gold has already appreciated significantly from previous lows. Some argue the move has already happened. Others argue that current conditions justify further appreciation if inflation persists or central banks continue accommodating. Silver historically moved with gold but with more volatility. The same monetary concerns that favour gold favour silver, but silver has industrial applications that add another dimension. Manufacturing demand creates price support beyond monetary factors alone. Silver's lower price point makes it accessible to smaller investors. Its historical relationship with gold suggests potential for significant percentage gains if monetary conditions favour precious metals broadly. Commodities beyond precious metals performed well during 70s inflation. Raw materials, agricultural products, energy, the things economies need regardless of conditions. When currency loses value, the prices of real things increase to compensate. Commodity investments provide exposure to this dynamic. Commodity-focused funds, agricultural investments, energy exposure. These positions benefited historically when inflation eroded currency purchasing power. Energy stocks specifically benefit when oil prices rise. Companies producing oil see revenues increase with prices. Unlike consumers who suffer from high energy costs, energy producers benefit. Their stock prices reflect this improved profitability. Energy ETFs provide diversified exposure to the sector without requiring selection of individual companies. If oil prices continue rising due to geopolitical factors or supply constraints, these positions capture upside. Farmland represents another asset class that performed well during inflationary periods. Agricultural land produces food that people need regardless of economic conditions. The land itself appreciates during inflation as real assets outperform financial assets. Direct farmland investment requires substantial capital and expertise, but investment vehicles exist that provide exposure. Farmland REITs, agricultural companies, food producers. These offer participation in agricultural economics without requiring direct farm ownership. Real estate beyond farmland historically provided inflation protection. Property values and rents tend to rise with inflation, maintaining purchasing power for owners. The tangible nature of real estate creates value that financial assets may not preserve. Real estate faces complications from interest rates that affect affordability. But inflation protection characteristics remain relevant for investors concerned about currency debasement. Important differences between the 70s and today affect how historical patterns might translate. Tariffs play a larger role today. The 70s featured less trade policy as an inflationary driver. Current policy uses tariffs strategically, creating inflation through trade barriers rather than just monetary expansion. This adds a price pressure that monetary policy alone cannot address. Modern Fed leadership reflects different priorities. Political influence shapes who leads the central bank and how they interpret their mandate. Current leadership may prioritize different objectives than previous Fed chairs did during inflationary periods. If leadership prioritizes economic stimulus and accepts higher inflation, rather than fighting it aggressively, different investment positioning makes sense than if aggressive rate increases were expected. A deliberately weaker dollar could result from policy choices that accept inflation as preferable to recession. Assets that benefit from dollar weakness, including gold and commodities priced in dollars, would perform well under such policy. Gold has already been rising. Unlike the start of the 70s when gold began from suppressed levels after official price fixing ended, gold today starts from higher valuations reflecting previous economic uncertainty. This doesn't mean gold can't rise further, but the starting point differs. The magnitude of percentage gains possible may differ from the extraordinary 70s performance. Technology stocks dominate today's economy in ways that the Nifty 50 stocks of the 70s didn't. The largest companies today are technology giants making massive AI investments. This concentration creates dynamics that historical parallels don't address. Some technology companies may benefit from inflation if they can raise prices faster than costs increase. Others may struggle if their growth depends on low interest rates and easy financing. Understanding which technology positions make sense requires analysis beyond simple historical analogy. The 70s eventually ended with aggressive rate increases that crushed inflation, but also crushed asset prices temporarily. The possibility of similar policy exists today. If the Fed eventually chooses inflation fighting over accommodation, different positioning would be appropriate. This uncertainty means investment strategy should consider multiple scenarios rather than betting everything on a single outcome. Investment opportunities in the current environment emerge from understanding these dynamics. Studying history to identify sectors that thrive during economic shifts provides framework rather than formula. The specific companies and instruments that capture opportunity require research beyond historical pattern recognition. But history suggests where to look. Assets historically resilient to inflation deserve attention. Gold, silver, commodities broadly, energy, agricultural land and related investments. These categories outperformed during previous inflationary periods because their value was tied to real things rather than financial promises. Allocating exposure to these categories provides insurance if inflation persists longer than markets currently expect. The insurance may cost in terms of opportunity cost if inflation resolves quickly, but the protection may prove valuable if inflation proves stubborn. Understanding risk remains essential. Markets can decline sharply regardless of historical patterns. Geopolitical events can produce unexpected outcomes. Policy decisions can surprise in either direction. Position sizing should reflect this uncertainty. Rather than betting everything on any single outcome, diversified exposure to various scenarios provides resilience against being wrong about specifics, while capturing opportunity if general direction proves correct. The current environment rewards flexibility over conviction. Conditions can change rapidly. New information emerges constantly. Positions appropriate today might require adjustment tomorrow. Maintaining ability to adjust rather than locking into inflexible positions preserves optionality that uncertain environments demand. Education and research provide the foundation for navigating this environment. I'm not providing investment advice. I'm providing context that enables informed decision-making. Investors who understand trends make better decisions than those who follow predictions blindly. Predictions fail constantly. Understanding persists. Understanding why gold performed well in the 70s provides more value than being told to buy gold today. The understanding allows you to evaluate whether current conditions warrant similar expectations. The understanding allows you to recognize when conditions change in ways that alter the thesis. Historical patterns provide tools for analysis, not guarantees of outcome. Learning how previous crises unfolded in which investments prospered helps develop intuition about current conditions, but applying that intuition requires ongoing attention to how present circumstances differ from past ones. Research into specific investment vehicles that capture desired exposure matters. The general categories I've mentioned, gold, silver, commodities, energy, farmland, can be accessed through various instruments. Some are more efficient than others, some have costs that undermine returns, some have risks beyond the underlying exposure. Understanding these details requires work beyond recognizing the general framework. But the framework provides direction for where to focus research efforts. Community and ongoing learning provide advantages that isolated research cannot match. Others studying similar patterns may notice what you miss. Discussion sharpens thinking. New developments require interpretation that benefits from multiple perspectives. Market uncertainty persists despite historical parallels. Nothing I've described guarantees any particular outcome. Even with strong historical parallels, future outcomes remain unpredictable. The geopolitical situation could resolve peacefully tomorrow. Oil prices could stabilize. Inflation could subside without dramatic policy changes. All the conditions suggesting certain investments might perform well could reverse. Alternatively, conditions could intensify. Conflict could escalate. Inflation could accelerate. Policy responses could prove inadequate or counterproductive. Both scenarios are possible. Many intermediate scenarios are possible as well. The variables interacting to produce outcomes include factors that cannot be predicted reliably. Federal Reserve decisions depend on data that hasn't been collected yet, and on judgment calls by individuals whose thinking cannot be known in advance. Geopolitical events depend on decisions by foreign leaders operating under pressures invisible to outside observers. AI development and its economic impact depend on technological progress that inherently contains unpredictability. Global economic policies and other major economies affect American investments, but emerge from political processes in those countries that Americans cannot influence or always anticipate. This irreducible uncertainty means investment positioning should account for being wrong. Concentration that produces maximum gain if correct produces maximum pain if incorrect. Diversification that captures less upside, if correct, provides protection, if incorrect. The practical application of understanding these dynamics begins with recognizing what you're actually trying to achieve. If Federal Reserve policy continues accommodating inflation rather than fighting it aggressively, certain asset categories have historically benefited. Gold and precious metals benefit from currency debasement that inflation represents. Commodities broadly benefit from the same dynamic, plus any supply disruptions that geopolitical events create. Energy specifically benefits if oil prices remain elevated or increase. Farmland and agricultural investments benefit from both inflation protection and fundamental food demand that persists regardless of economic conditions. Real estate can benefit from inflation protection, though interest rate dynamics complicate the picture. These positions provide exposure to scenarios where inflation persists and Fed policy prioritizes accommodation over aggressive tightening. If Federal Reserve policy shifts to aggressive inflation fighting similar to the late 70s, different positioning would be appropriate. Cash and short-term bonds become attractive when rates are high. Stocks typically suffer during aggressive tightening before eventually recovering. Preparing for this alternative requires maintaining flexibility. Positions that would benefit from accommodation should be sized so that aggressive tightening wouldn't be catastrophic. Cash reserves provide ability to reposition if conditions change. The opportunity cost of holding cash becomes investment capital if circumstances shift. Understanding your own time horizon affects appropriate positioning. Younger investors with decades until retirement can tolerate volatility that older investors approaching retirement cannot. The fluctuations that represent opportunity for patient investors represent danger for those who need stable assets soon. Risk tolerance varies independently of time horizon. Some people psychologically cannot handle portfolio declines even when they can financially afford them. Understanding your actual response to volatility rather than your theoretical response prevents positioning that leads to panic selling at the worst times. Current income needs affect how much portfolio volatility is acceptable. Investments that might appreciate significantly over time don't help if you need consistent income and they produce none. These personal factors should shape how aggressively you position for any particular scenario. The same understanding of Fed dynamics and historical patterns produces different portfolio construction for different people. The opportunity I see emerging from current conditions involves wealth transfer that crises typically produce. During the 70s, wealth didn't disappear, it transferred. From holders of devaluing currency to holders of appreciating real assets. From those who didn't understand what was happening to those who positioned correctly. Similar transfers occurred during subsequent crises. The financial crisis transferred wealth from over-leveraged institutions to those with capital to deploy at distressed prices. The pandemic transferred wealth from businesses that couldn't adapt to businesses that could. The current environment may be producing another transfer, from those positioned for conditions that no longer exist to those positioned for conditions that are emerging. I can't tell you with certainty what position captures this transfer. Nobody can. The uncertainty is real. But I can tell you that ignoring the patterns visible in current conditions and hoping everything returns to normal seems like the strategy most likely to leave you on the wrong side of any transfer that occurs. Understanding what's happening provides opportunity to be on the right side, not certainty, opportunity. The action. This understanding suggests begins with education rather than immediate trading. Recognizing patterns in Fed actions and economic disruptions provides foundation for decisions. Before positioning, understand what you're positioning for and why. Identify assets that historically profit during scenarios similar to current conditions. Research the specific vehicles available to access those assets. Understand the costs, risks, and mechanics of each option. Use knowledge to potentially grow wealth while managing risk. Position sizing should reflect uncertainty. Diversification should provide resilience. Flexibility should enable adaptation. Don't treat historical patterns as guarantees. They provide guidance, not certainty. Conditions might unfold differently. Timing might differ. Magnitude might differ. But the alternative, ignoring patterns entirely and hoping for the best, doesn't seem wiser than studying what has worked before and adapting it thoughtfully to current conditions. The Federal Reserve's actions over the coming period will significantly affect wealth distribution. If they continue accommodating inflation, The assets I've discussed should perform well historically. If they shift to aggressive tightening, different positioning becomes appropriate. If they attempt to thread the needle between these approaches, mixed outcomes become likely. Monitoring Fed communications, economic data, and policy decisions provides information that should inform positioning adjustments. This isn't a one-time decision, but an ongoing process of understanding and adaptation. The potential for significant wealth creation exists in environments like the current one. The 70s produced fortunes for those who recognized what was happening and positioned accordingly. The same potential exists now. Different specific opportunities, same general dynamic of wealth transferring from those who don't understand to those who do. Write in the comments how you're thinking about Fed policy and its impact on your investments. What positioning changes, if any, are you considering based on current conditions? Sometimes articulating your thinking helps clarify it. Share this with someone who's focused only on stock market returns, without considering how Fed policy and inflation affect those returns. The broader context might change their perspective on appropriate positioning. The Fed's decisions will make some people significantly richer over the coming years. They'll also make some people significantly poorer. Which group you're in depends partly on understanding what's happening and positioning accordingly. Now you understand more about what's happening. What you do with that understanding is your choice. But doing nothing because the situation seems complex is itself a choice. It's choosing to accept whatever happens rather than positioning for preferred outcomes. Understanding provides the opportunity to choose more deliberately. The patterns are visible, the historical precedents exist. The current conditions rhyme with periods that created fortunes for those who recognize them. Whether this time produces similar results remains uncertain. Whether you're positioned to benefit if it does is within your control. Position with understanding. Position with appropriate risk management. Position with flexibility to adapt as conditions evolve. But position deliberately rather than passively accepting whatever happens. The opportunity exists for those who recognize it. Now you know what I see. The rest is up to you.